Welcome to Real Estate Economics webinar series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. Real Estate Economics webinar series covers different topics of interest to the home building, land development, and lending industries. I'm John Mulville, Vice President of Consulting here at Real Estate Economics. I'll be presenting today's National Economic and Housing Market Forecast. At any time, you can check our website, www.realestateeconomics.com, to register and get advance notice of our upcoming webinars. Next week, we'll be presenting trends in labor and materials costs. 2 weeks, it'll be the Texas overall market forecast and overview. Let's jump into the national today. A couple of themes we're going to run with today is that across the nation there are strong markets and weak markets. Recession, as they tend to do, are creating winners and losers. Winners and losers in terms of states, in terms of regions, in terms of MSAs, in terms of submarket. It becomes absolutely imperative to identify the winners and losers and operate in the winning markets and avoid the losing markets. We're going to look at some employment data later in this series, but we would encourage everyone to check the employment characteristics of their submarket. We'll show you how, and make sure you're operating in markets with high employment growth and employment growth in the higher wage categories. As we see it today, and the survey data and the polling data shows the same thing, that consumer sentiment is not that great. Expectations are low. The numbers are very high in terms of people who don't expect to raise this year, whose household net worth is down. There's considerable data that people are saving more and spending less. To that point, there's data on credit card usage that in 2007, 87% of households used a credit card during that calendar year. That dropped to just 56% of households using a credit card in 2009 and only 45% in 2010. Clearly, consumers are saving more, spending less, and have different opinions about credit than they had prior to the recession and this weak post-recovery period we've had. Household financial health remains in limbo. Debt levels are elevated. We can see that through the data. Back in 2008, 136% was the average debt level compared to household income. Now that's come way down to about 107% in 2010, but the long-term average for numbers like that is just 70 to 80%, which means we'd need to shed about $6 trillion with a T dollars in household debt to go back to 1980 levels. That really leads to people cutting back. As everyone has seen, food, gas, and everyday staples are increasing, while incomes, especially real incomes adjusted for inflation, are very flat. People have reported that 71% of households have bought less expensive brands or eat at cheaper restaurants. 57% have eliminated vacations. 11% have postponed marriage or having children based on economic conditions. And one of the key things we've seen in the news recently, state budgets and public policies are increasingly driving economic trends. Whether we like it or not, and however you feel about these issues, employers are going to choose to operate in the states where they have the best economic and labor environments. Let's jump into the data. This is the national employment data by super sector. You can see in the pie chart the large sectors, super sectors we like to call them. 19% of the national employment is in trade, transportation, utilities, 17% in government, 15% in education, health services. In our online library, you can generate this report for practically any market area. We think this is critical to understanding the employment picture market to market. If you're in an area that's dependent on one industry, or where one industry is growing, one industry is declining, it may be critical to establishing demand in your market. For example, we see some markets in California where government takes 33%. Now we're concerned about government budgets going forward. That may not be a high demand area as we evaluate housing market conditions going forward. Let's look at national employment 2009. We'd like to draw some comparisons to 2010. In 2009, of course, we had huge job losses. I think the national figures ran around 7 million total jobs, 1.2 million roughly in California. You can see where those job losses occurred. Manufacturing, trade, transportation, utilities, construction, professional business services, financial activities. There were very few categories that were unaffected. But we have a character change coming forward to 2010. We were losing some government, not much through outright layoffs, but quite a few hiring freezes are in place, and so there is some consistent attrition there. Construction is still losing in many markets, but we're showing a rebound in educational and health services, professional and business services, leisure and hospitality's come back quite well. We even have good manufacturing strength in certain locations. Now we expect this to continue into 2011. This shows national non-farm employment on a 12-month change basis. Shown in pink is our forecast period. So we're coming off the tremendous trough where the job losses were so significant in 2009, where we reached 600, in excess of 600,000 on the unemployment data, weekly unemployment data. Now we're starting to pick up some employment, but this varies significantly. We see markets where literally all of the employment gains are in high income categories. We go to other markets and much of the gains where there are gains are in low employment categories. So it behooves us to examine these markets carefully, location to location, and if we're interested in building, that we target the high demand settings. This is employment history and forecast for the nation, United States, on an annual basis. You can see our peak in jobs was 2007 at about 137,600,000. Come forward to 2011, we're at 132,700,000. So really, on an annual basis, we're down about 5 million jobs at present. It's generally recognized that we need about 150,000 per month, or 1.8 million per year, to keep up with demographic expansion. So if we, by the time we get to 137 million again in 2013, that still won't make jobs for all the people that are entering the workforce every year. One of the problems we see in the labor force is labor force participation rate, and that's the percent of the population that's active in the labor force. This chart goes back quite a ways, so you can see in the 60s, the 70s, and the 80s, when women entered the labor force in much greater numbers than they ever had in the past, peaking out about year 2000, over 67%. We've pulled all the way back to the current figure of 64.2%. If we calculated the current unemployment rate based on these peak numbers of over 67%, we'd have about 11.5% unemployment. You can see the recessions in gray, but we've had the labor force participation rate come down through recession and through the expansions between the recessions. And one of the problems with losing labor force participation percentages is that many of these people tend to end up on disability rolls or other forms of public support. So it's important that we keep people working wherever we can. Here's national unemployment. Remember, these are full year figures, so the numbers might vary. I think the present rate is 8.9% on an annual basis for 2011, or on a current basis for 2011. These are annual figures. We've got some improvement coming slowly over the next few years. It doesn't really take the rate down as quick as we're all hoping. One of the reasons for that is goes back to our labor force participation and other factors. As the employment economy improves, people will come back into the workforce. People end up being discouraged workers and they fall off the rolls, if you will. But as employment opportunities present themselves, people will go out and look for work again. There's another phenomenon we've seen in this recession, past recession, much more so than in the past, is labor mobility. Workers have not been as mobile in the past few years as they had in recessions past. Now that's ending. That mobility is really picking up as people are beginning to broaden their geographic search horizons for employment. One of the things that this economic malaise leads to is very weak permits. Here we have annual permit figures again, all annual, all national. You can see the last few years we've had below 5 million. Those are the lowest numbers going back to the early 90s when the labor force and the population was much smaller. One of the things that has happened is that permits have gone down very quickly, which has kept us from adding supply in the numbers that produced overbuilding. Now, we obviously have overbuilding in some markets, but there are many markets that we have not added that much supply, even through the subprime period. And so as the economy recovers, there's not too much supply on the ground, which tends to lead to shortages in the real high demand price ranges and size ranges. Median home prices, national level. I've included two lines here. One, the lower red line, shows the 2010 and 2011 data. You can see that that compares to the data in about 2002 and about 2003. So we're really going back to prices that were effective on the ground 8 or 9 years ago. We'll show later in part 2 of today's presentation that housing's tremendously undervalued as we speak. It will take years to cure, but housing is clearly a tremendous bargain at this point. If you look at the high water mark shown in the green line that we get to in 2015, we still won't be exceeding the numbers that were observed during the peak of the subprime period. Let's look at the annual change in housing prices. Again, national numbers. Tremendous drawdown in 2007, 2008, 2009. These numbers are bouncing around, tending to be, up a couple points, down a couple points. This is very area dependent. So when you look at the nation, we're still having large numbers of foreclosed homes in the data. Those homes tend to be the very lowest rung on the price ladder. So the high volume in those foreclosures and foreclosure sales is really keeping a lid on the numbers here. We would expect over the next 3 to 4 to 5 years that prices will be trending up, not so much due to economic improvement, but due to an unwinding of the tremendous undervaluation that we'll demonstrate exists on the ground at present. That's the end of part 1 today. Please join us for part 2 of today's National Economic Webinar.